I wasn't going to make this video today. Then I saw one document, one single COT report that changed everything. JPMorgan, the bank that accumulated the largest physical silver hoard in modern history, just sold their long positions, not to take profit, not because silver is overvalued, but to hand a lifeline to HSBC. HSBC, sitting on a short position so massive, so concentrated, that if silver breaks through one specific price level, the entire paper market could unravel in 72 hours. And here's what nobody's telling you. This isn't the first time they've done this. It's the third coordinated move in 90 days, which means someone at the highest level knows something. And they're running out of time to contain it. Welcome to Currency Archive, where we don't insult your intelligence with hype. If you've been around long enough to remember when markets actually made sense, do me a favor and hit that subscribe button and drop a comment below. What city are you watching from today? Because what I'm about to show you, geography might actually matter this time. To understand what just happened, a person needs to go back exactly 14 years. February 2011, silver was trading at $31 an ounce. And something absolutely bizarre was happening in the futures market. There was this one bank, HSBC, sitting on a short position so large that analysts couldn't even explain it. Not a hedge, not a normal trading position, but a concentrated bet that silver would collapse. The kind of bet that only makes sense if someone knows the collapse is coming, or if someone has the power to make it come. Fast forward to May 2011. Silver hits $49, the highest price in 31 years. HSBC's short position is now underwater by billions, and then something strange happens. Within 5 trading days, silver drops from $49 to $33. A 33% crash in 1 week. No economic catalyst. No Federal Reserve announcement. Just a violent, unexplained liquidation that wipes out retail traders while the big banks walk away clean. In HSBC, their massive short position suddenly becomes profitable again. Convenient. Now, most people forgot about that story, but the people who actually hold physical silver, they never forgot. Because they learned something that day. The price on the screen and the metal in the vault are two completely different games. One is controlled by algorithms and margin calls. The other is controlled by geology and refineries. And here's where it gets interesting. For the next 13 years, JPMorgan does something that Wall Street has never seen before. They start accumulating physical silver, not paper contracts, not ETF shares, but actual bars sitting in actual vaults. By 2020, independent analysts estimate JPMorgan holds somewhere between 800 million and 1 billion ounces of physical silver. That's roughly 1 full year of global mine supply. One bank, one vault, one position that dwarfs entire countries. And the whole time, HSBC stays short, year after year, quarter after quarter. The commitment of traders reports show the same pattern. HSBC and a handful of other banks holding massive short positions. While JPMorgan sits on the other side with the actual metal, it was the perfect setup. JPMorgan controlled the physical, HSBC controlled the paper price through futures, and retail investors were stuck in the middle, watching the price get smashed every time it tried to break out. But then, 2024 happened. China announced export restrictions on antimony, then germanium, then gallium. And quietly, behind the scenes, they started restricting refined silver exports too. Not officially, not publicly, but the data doesn't lie. Chinese silver exports dropped 40% year over year, and suddenly the physical market started tightening. Refineries in Europe couldn't get material. Dealers in the Middle East started paying premiums 15% above spot, and the COMEX warehouses, they started bleeding inventory. January 2024, 320 million ounces registered. January 2025, 210 million ounces, a 34% drop in 12 months. And here's the problem. HSBC's short position is still there, still massive, still concentrated, but now the physical market is fracturing. In Dubai, physical silver is trading at $127 an ounce. On the COMEX screen, $73. That's a 74% disconnect. The largest gap between paper and physical in modern history. And someone at JPMorgan is watching this. Someone who understands that if this gap keeps widening, if buyers start demanding physical delivery instead of cash settlement, the entire futures market could implode. Because here's the dirty secret about COMEX. It's a fractional reserve system. For every 100 ounces of silver traded on paper, there's maybe 5 ounces of actual metal backing it. It works perfectly fine, as long as nobody asks for delivery. But the moment people start asking, the moment Middle Eastern buyers or Chinese manufacturers say, "We don't want your cash, we want the metal," that's when the leverage unwinds. That's when margin requirements spike. That's when banks get margin calls they can't meet. And HSBC, they're sitting on the wrong side of that trade. So what does JPMorgan do? They make a move that sounds insane on the surface, but makes perfect strategic sense if you understand what's really happening. They sell their long positions, not their physical metal, but their paper longs, the futures contracts that were pushing silver higher, and they do it quietly, strategically, just enough to take pressure off the price, just enough to give HSBC breathing room, just enough to prevent a margin call that could cascade through the entire system. Because if HSBC goes down, if one major bank fails to deliver on a silver contract, the credibility of the entire paper market collapses. And when that happens, every hedge fund, every pension plan, every sovereign wealth fund that holds paper silver will panic. They'll all demand physical delivery at the same time. And there isn't enough metal on planet Earth to cover those claims. That's what JPMorgan just prevented, not because they're heroes, but because they need more time. The question is, time for what? What they sold were their paper claims on future silver, the contracts that give them the right to buy silver at fixed prices. And by doing that, they accomplished three things simultaneously. First, they released selling pressure into the futures market, which pushed the paper price down and gave HSBC room to exit their shorts without triggering a margin cascade. Second, they protected the broader system from a derivatives blow-up that could have rippled through every major bank trading precious metals. Third, they widened the gap between paper and physical even further, because now physical buyers in Dubai, Singapore, and Hong Kong are looking at COMEX prices dropping. While their local dealers are raising premiums higher, the cognitive dissonance is becoming impossible to ignore. And here's the truly fascinating part. JPMorgan's physical silver hoard becomes more valuable with every percentage point that gap widens. Think about it. If you own 800 million ounces of physical metal, and the paper price says $73, but the real-world price for immediate delivery is $127, your actual asset value just increased by $43 billion above what the official scoreboard shows. That's not a position, that's a nuclear option. Because the moment JPMorgan decides to stop playing nice, the moment they say, we're taking delivery on every contract we hold, or worse, we're only selling our physical at spot plus 70%, the entire pricing mechanism collapses. COMEX loses all credibility, futures become worthless paper, and physical metal becomes the only real currency, but JPMorgan isn't pulling that trigger yet. And that's the part that should concern everyone paying attention. Because if they're not pulling the trigger, if they're actually helping HSBC escape, if they're actively suppressing the price even while holding massive physical, it means they're buying time for something bigger, something that hasn't been announced yet, something that requires the current system to stay functional just a little bit longer. And when a bank with JPMorgan's track record starts making moves that sacrifice short-term profit, that's not charity, that's chess. So what are they waiting for? What event are they positioning around? And more importantly, what happens to everyone holding paper silver when that event finally arrives? The contracts that give them the right to buy silver at fixed prices. And by doing that, they accomplished three things simultaneously. First, they released selling pressure into the futures market, which pushed the paper price down and gave HSBC room to exit their shorts without triggering a margin cascade. Second, they protected the broader system from a derivatives blow-up that could have rippled through every major bank trading precious metals. Third, they widened the gap between paper and physical even further. Because now physical buyers in Dubai, Singapore, and Hong Kong are looking at COMEX prices dropping. While their local dealers are raising premiums higher, the cognitive dissonance is becoming impossible to ignore. And here's the truly fascinating part. JPMorgan's physical silver hoard becomes more valuable with every percentage point that gap widens. Think about it. If you own 800 million ounces of physical metal, and the paper price says $73, but the real-world price for immediate delivery is $127, your actual asset value just increased by $43 billion above what the official scoreboard shows. That's not a position, that's a nuclear option. Because the moment JPMorgan decides to stop playing nice, the moment they say, we're taking delivery on every contract we hold, or worse, we're only selling our physical at spot plus 70%, the entire pricing mechanism collapses. COMEX loses all credibility, futures become worthless paper, and physical metal becomes the only real currency, but JPMorgan isn't pulling that trigger yet. And that's the part that should concern everyone paying attention. Because if they're not pulling the trigger, if they're actually helping HSBC escape, if they're actively suppressing the price even while holding massive physical, it means they're buying time for something bigger, something that hasn't been announced yet, something that requires the current system to stay functional just a little bit longer. And when a bank with JPMorgan's track record starts making moves that sacrifice short-term profit, that's not charity, that's chess. So what are they waiting for? What event are they positioning around? And more importantly, What happens to everyone holding paper silver when that event finally arrives? There's a moment in every market manipulation where the mechanics stop mattering, and psychology takes over. That moment usually arrives when regular people start noticing something the experts said was impossible is actually happening. And in silver markets right now, that moment just arrived in the most unlikely place imaginable. Not New York, not London, not even Shanghai. India. Specifically, a city called Ahmedabad in the state of Gujarat. Now, most Western investors have never heard of Ahmedabad, but it's home to some of the largest gold and silver dealers in Asia. Families who've been trading precious metals for 6 generations, people who can smell manipulation from 6,000 miles away. And starting January 28th, these dealers did something they haven't done in 40 years. They stopped quoting prices entirely, not because they ran out of silver, but because they couldn't figure out which price to use anymore. One of the largest dealers, a man named Rajesh Khanna, told his customers something that should have made international headlines. "The number on your screen is a fiction. I cannot sell you metal at a fictional price." He wasn't being poetic. He was being literal. Because here's what was happening on the ground in India. Local refineries were quoting $11,400 per 100 grams. That's roughly $154 per ounce in dollar terms. But COMEX was showing $73. So when buyers walked into shops asking to buy at spot price, dealers had an impossible choice. Sell at the COMEX price and lose our $7,800 per transaction, or refuse the sale and watch customers think they're scamming them. Most chose option 3, close early and wait. And that's when the Indian government noticed, because India imports roughly 4,000 tons of silver annually, most of it for industrial use, jewelry, and religious purposes. When dealers start closing shops during wedding season, when refineries stop accepting new orders, bureaucrats start making phone calls. And according to sources inside India's Ministry of Finance, those phone calls went straight to the Reserve Bank of India, who then contacted their counterparts at the Bank for International Settlements in Basel. The message was simple: fix your pricing mechanism or we'll source elsewhere. Now, that might sound like an empty threat, but India isn't some tiny player throwing weight around. They're the second largest consumer of silver on planet Earth. And when your second largest customer says the price discovery system is broken, you don't ignore that. You especially don't ignore it when that customer has been quietly building trade relationships with Russia, China, and the UAE, all of whom would love an excuse to bypass Western commodity exchanges entirely. So now the BIS has a problem. COMEX has a credibility crisis. And JPMorgan is sitting in the middle watching the whole thing unfold. But here's what makes this particularly dangerous for HSBC. Their short position isn't just a bet that silver goes down. It's a bet that the COMEX pricing mechanism remains the global reference point. The moment buyers start ignoring COMEX prices, the moment they start saying, "I don't care what your screen says, I'm paying Dubai rates," HSBC's entire position becomes unhedgeable, because you can't cover a short position in a market that no longer exists. And that's exactly what's starting to happen. Over the past 3 weeks, institutional buyers have started doing something unprecedented. They're writing dual price contracts. Contracts that say, we'll settle at COMEX price or physical delivery price, whichever is higher at contract maturity. It's basically a clause that says, we don't trust your paper anymore, so we're hedging the hedge. And the banks hate it, because it destroys the entire purpose of futures markets. Futures were designed to transfer price risk from producers to speculators, but if every contract now includes a "just kidding, we want the real price" clause, the risk doesn't transfer anymore. It just accumulates on bank balance sheets, in derivative books, in positions that looked safe when silver was $22 and everyone trusted the system, but look absolutely catastrophic when silver is $73 on paper and $127 in reality. So when JPMorgan sold those 18,000 long contracts on February 4th, they weren't just helping HSBC cover shorts. They were trying to reestablish COMEX credibility. By pushing the paper price down, they were sending a message. See, the futures market still works. Prices still respond to supply and demand. Everything is normal. But the problem is, dealers in Ahmedabad aren't watching COMEX anymore. Buyers in Dubai aren't checking futures prices. Refiners in Switzerland are quoting premiums that have nothing to do with New York's closing bell. The decoupling has already happened. The only question now is how long the big banks can pretend it hasn't. Because there's a rule in markets that never gets broken. Reality always wins. Not today, not this week, maybe not even this quarter. But eventually the gap between fiction and physics closes. And when it does, someone is going to be standing on the wrong side holding worthless paper, while someone else walks away with all the metal. JPMorgan knows which side they're on. HSBC is fighting to avoid finding out which side they're on. And retail investors? They're still being told everything is fine. There's a question that nobody in mainstream financial media is asking right now. And it's the only question that actually matters. Why now? Why did JPMorgan choose this exact moment to sell their long positions? Why not 3 months ago when silver was at 30 taels? Why not wait until March, when industrial demand typically surges? Why February 4th, 2025? Because if there's one thing 14 years of watching these banks has taught anyone, they don't make moves based on chart patterns or technical analysis. They make moves based on calendar events, things that haven't been announced yet, things the public won't know about until it's too late to react. And when you start looking at what's scheduled for the next 60 days, the picture becomes disturbingly clear. March 15th, 2025. That's the date when the next round of Basel III regulatory requirements takes full effect for U.S. banks. For those unfamiliar, Basel III is the framework that determines how much physical collateral banks need to hold against their derivative positions. And under the new rules, unallocated gold and silver, the kind that only exists on paper, gets classified as zero-tier collateral, meaning it counts for nothing. But allocated physical metal, the kind sitting in vaults with serial numbers, that gets classified as Tier 1 collateral, same value as cash. Now guess which bank has been stockpiling allocated physical silver for 13 years? JPMorgan. And guess which bank has been holding massive unallocated short positions that will suddenly require enormous capital reserves under the new rules? HSBC. So what JPMorgan just did wasn't a rescue operation. It was a pre-positioning move. By selling their paper longs now, they accomplished two things. First, they gave HSBC a narrow window to reduce their short exposure before March 15th, when the regulatory hammer drops. Second, they freed up capital to potentially acquire HSBC as precious metals desk entirely when the new rules make it too expensive for HSBC to operate, because that's the real endgame here. JPMorgan isn't trying to save HSBC, they're trying to absorb them. Think about it. If HSBC can't meet the new capital requirements for their silver shorts, if they're forced to either close the position at a massive loss or sell the entire division, who's the only buyer with enough physical metal and regulatory compliance to take it over? JPMorgan. And the beautiful part, from JPMorgan's perspective, is that they get to set the price. Because HSBC will be negotiating from a position of regulatory desperation, not market strength. It's the same playbook JPMorgan used during the 2008 financial crisis when they acquired Bear Stearns for $2 a share, a company that was worth $133 a share just 12 months earlier. Financial warfare disguised as a bailout. But here's where it gets even more strategic. If JPMorgan absorbs HSBC's precious metals division, they don't just control the physical supply anymore. They control both sides of the paper market too. The longs, the shorts, the inventory, the pricing mechanism, everything. At that point, they're not a market participant anymore. They are the market. And that's when things get very dangerous for everyone else, because a monopoly in a commodity market doesn't just control price, it controls access. Who gets metal and who doesn't, who gets delivery and who gets cash settled, who stays in business and who gets squeezed out. And if you think regulatory agencies will step in to prevent that, remember who got bailed out in 2008. Remember who paid fines but faced zero criminal charges after the LIBOR scandal. Remember who the Federal Reserve called first when they needed someone to buy up toxic mortgage assets. JPMorgan isn't too big to fail. They're too connected to fail. So when silver stackers ask, when will the manipulation end? The answer might be, never. It might just change management. From a multi-bank cartel to a single dominant player with government blessing. Which brings us to the real question every investor needs to ask themselves right now. What do you do with this information? If you're holding paper silver, ETFs, futures contracts, unallocated pool accounts, you're holding a claim on a system that's consolidating control, not decentralizing it. If you're holding physical silver in your possession, you're holding the one asset that can't be rehypothecated, can't be margin called, and can't be seized through a brokerage account freeze. And if you're sitting on the sidelines thinking, I'll wait until this shakes out, you're making the same mistake retail investors made in 2008 when they waited for Lehman to stabilize. By the time the smoke clears, the metal's already gone. The premiums are already 200% above spot. And the only people selling are the ones who bought years ago. Because here's the truth that nobody wants to say out loud. This isn't a battle between bulls and bears anymore. It's a transfer of wealth from people who trust the system to people who understand the system is designed to transfer wealth. JPMorgan understands that. HSBC just learned it the hard way. The only question left is, which side of that transfer are you on?